the senior investment strategist at Stanchart Bank, joining in on the show right now. Fook, great to have you today on ET Now. Thanks for your time. And Fook, as inflation in the US has cooled off, the focus clearly has shifted back to oil, and it's back above that $90 per barrel mark. What do you sense would be Fed's commentary next? And should we gear up for an extremely hawkish stance?
Yeah, no, thanks very much for having me. Look, I think our view is that the Fed now would be very much data dependent. I think in line with new Fed Chair Kevin Walsh, he wants to lessen the guidance, a bit more data dependent. And look, the last data print we've seen is that CPI has come off. It's been a long time since we've had a negative inflation month on month. And I mean, a lot of that was because of oil price coming off. So in a way, we do see peak hawkishness as behind us. A lot of this, of course, depends on the data that will be coming through. But if we are right, then we think the Fed will then be on hold for the rest of the year. Look, the market pricing at the moment is that September is still quite live. I think the market is putting a 70% chance of a Fed hike there. Our view is that it'll be on hold, but yeah, you rightly pointed out oil prices. I think that's very volatile, reacts to events that are happening in the Middle East. Our view is still that the US administration going into the midterm elections, they have a strong incentive to de-escalate and have the oil price come down. And most parts of the world actually want the Strait of Hormuz to reopen. We saw a peace plan about a month plus ago. That was actually quite favorable for Iran. Of course, recent events have put that in the background. That's faded. But we do expect some de-escalation as well to come forth. But it is a volatile situation. But if the base case then plays out, then yeah, we do see Fed hawkishness has peaked, and therefore we do see rates being on hold for the rest of this year.
What is your own anticipation about how crude is likely to move? I mean, while we've been in a range from 70 all the way to 90, but do you sense that there could be a spike above 90, and will it sustain, more importantly?
Yeah, that's a great question, $1 million question. I mean, our own view is that in 3 months, WTI will be 70 to 90, or midpoint of $80, if you like. And look, I mean, it did go to 70 after the peace plan was announced, which we thought was a bit of an overreaction, given that, at $70, a lot of countries which had drawn down on their reserves, they'll get a chance, they want to replenish their reserves. But of course, right now, it's at the upper end of our view over the next 3 months, $70 to $90. So yeah, I mean, it would depend on the events that unfold. Our 12-month view, if you like, is $70 because we do see after it goes through a period of a de-escalation, you still need the logistics of restarting things and getting tankers into place. And eventually that ample supply will come through over 12 months. So it's probably easier for us to look at the demand and supply over 12 months where we can see $70 for the WTI. But in the near term, I think, yeah, if we do see more escalation, of course, it could push towards a $100 mark. But then, as I said before, I think there is a strong incentive from the US administration and other parts of the world, Asia as well, a lot of power brokers in place there who want to de-escalate, who want the Hormuz to reopen.
Hi, at Standard Chartered, you have overweight on India and China. We've seen some kind of correction happening in Taiwan and Korea there. Do you see rotation of money happening and that money coming into India?
Yeah, I think since the start of July, China has been doing well. And actually since the peace plan and the Hormuz reopening, I think India has been picking up after many months of underperformance. We do see some profit taking, especially in Korea and Taiwan, and some of those funds flowing back into India and China. So we do see some catch-up opportunity for India and China. And with China, I think the recent development as well is around their AI model that's been released, Kimi 3, and it revives memories of DeepSeek. It throws into questions as to how China is able to keep up with the US models, despite not having access to the largest chips. So I would say in the near term, actually, the news flow is quite positive for China. Valuation there remains very, very attractive. And yeah, I mean, the fact that they're able to keep up with the AI narrative, which continues to be a very big driver for global equities, I think that's positive for China. And for India, I think India is a domestic story. I think we've talked about valuation being high for a long time, but it has derated now. Valuation is attractive, and we do like India as a way to diversify away from the tech-driven narrative, because the domestic drivers within India, we think, remains intact for strong growth.
Fook, if I were to ask you, one, how should one look at AI? Is there a bubble there? Is there no bubble there? Is there some bit of exuberance which is justifiable, not justifiable? That's the first piece. Second, just in terms of flows, would India probably be at the top of the pack within the Asian marketplace from a flows perspective now going forward? Is that something that you would expect?
Yeah, I mean, in terms of the AI trade, we do not see a bubble, so to say. And I think within the AI space, there's been a lot of differentiation as well. I think more recently we've seen, up until this point, I think we've seen the memory semiconductors being extremely strong. We've seen big tech has been lagging a little bit. These are your big mega cap tech companies. They have been lagging a little bit. And this bottleneck has helped the memory supply chain. But of course, in recent weeks, that is reversing a bit more profit-taking on the memory semiconductor side. But look, I think our view really is that the AI trend continues. How you want to capture the upside here remains a question. We do think big tech has been underperforming, and there's a catch-up. And we do see the upcoming result season as being positive for big tech, and supportive because earnings continues to be very strong and valuation has been lagging. But a lot of eyes will be watching the AI monetization and how that comes about. But I think long story short, we are positive on the AI trade, but it's just which part of it you try to capture. At the moment, we see big tech as positive. The semiconductor correction, we think, has made it a little bit more attractive. But I think in terms of the flows that are going on, look, I think at the end of the day, it is, it's not a zero-sum game, I would say. I think you can see tech and AI going up and India going up as well. We do see India as being quite sensitive to news flow around the Strait of Hormuz, for obvious reasons, being an all-importing nation. So that seems to be where we see if the Hormuz is reopening, we see a bit more excitement. We'll go into India. It's been underperforming. It's like a catch-up opportunity now. Let's go into India. But if you get news flow again about it closing, then there'll be a bit more caution about India. And then the good thing about tech is that despite what's happening with the Middle East, in the background, investments continue. And that's why we see earnings continue to be upgraded for the whole AI tech space, despite what's going on with the geopolitics.
Fook, it was a pleasure talking to you today. Thank you very much for joining us from Singapore. That was